Welcome back to the podcast. I'm back from vacation. Ernest, you did a great job last week with the interview of David Baskin, talking about what to do in terms of your portfolio for fixed income, the underperformance of dividend-paying stocks. It's been really interesting. We've had such a wild move in the last 5 years in interest rates, and now it looks like, Ernest, that interest rates will be back on the downtrend again, given the inflation numbers in Canada and the U.S. seem to be coming in where the Federal Reserve and the Bank of Canada wants them to be.
Well, we just had the inflation numbers in Canada today, as of what day is today?
July 16th.
July 16th.
Yeah.
And
every day is the same, it feels like, since the pandemic. But anyways, yeah.
And inflation appears to be trending downwards again, which sets up the Bank of Canada for likely another rate cut in July.
And whether the Federal Reserve cuts interest rates in July or September or October, I think it's pretty clear at the moment that interest rates around the globe will start going down. The bond market, which everybody always says the bond investors are the smartest investors, interest rates on corporate bonds, on government bonds, have come down significantly. Only a few months ago, Ernest, we were buying corporate bonds in Canada going out 5 years that were paying up to 6%. Now those same bonds going out 5-6 years are paying 4.5%, 4.60%, 4.70%. So interest rates have dropped about on the long end about 1 to 1.2%. So that's what happens. Markets move, right? That's what makes it fun and exciting.
I do think that at some point, the market is going to be less concerned about the impact of higher interest rates and more concerned about sluggish economic growth overall.
Are we seeing any evidence of economic? Well, clearly you don't want the economy growing at that torrid pace that we had when interest rates were so low and everything got messed around with the supply shipments. It's clear that the employment numbers the last few months have not been as strong, especially in Canada, for example. But on the flip side, of course, that might mean that interest rates come down.
Right. So I think if I had to sum it up, hard to know exactly what this means for the stock market.
Impossible.
Which is what we're going to get into today.
A perfect example is 2024. Interest rates not coming down as much as one would have thought. Everybody's saying that valuation should be lower because interest rates are higher, yet here's the stock market's at record highs. So you never know what's going to happen. Just to finish off, your big takeaway from last week's podcast with David on interest rates?
Yeah, so I think the role of bonds has certainly been on a wild ride in a portfolio. When interest rates are zero, there's just basically no point of owning bonds because you're earning nothing. But if to the extent that interest rates stay a little more elevated than historical levels going forward, then it makes a lot of sense to have some.
And not to get too deep in the weeds, but when we talk about yields and interest rates, we're always talking about them in nominal dollars. If you add back taxes, inflation, you're still not making real money on fixed income, even though the nominal yields for GICs or safe money markets are 5%. It's really, you're not getting 5% because you have to include all those other variables, all those other factors, which are real and impact your net return.
And I think one last thing to say about interest rates and bonds in general is that I think a lot of investors often buy bonds at the wrong time. So when interest rates were going up, everyone was pulling money out of stocks.
Of course they were.
And the argument was, well, if I'm getting 5% on a GIC, why would I want to own stocks? Because I'm getting a decent return, maybe less so on a real basis, but it's still pretty good relative to what I've historically gotten. And you add to the fact that the stock market is falling, so I'm losing money in stocks. So why would I want to own stocks at all? And so what ended up happening is that you saw a big rotation into fixed income in 22 and 23. And these investors missed the large rally in 23 and 24.
Yeah. That's the way it always goes. When you think something is the safest, it's actually it's not safe. And of course, people seem to forget, and we need to reiterate this point every time. If a stock falls or falls a lot and the fundamentals are actually going in the right direction or improving or not getting worse, the stock has not become riskier. There's volatility in the stock price, but the investment is not riskier. In fact, it could be less risky because you might be paying a cheaper valuation going forward for that company's earnings as a result of the fall in the stock price, yet the fundamentals are improving. So, lots to keep in mind, of course, in investing, and it's never easy. And hopefully that's why you hire us. So today's topic, Ernest, is a first half review of 2024. We want to speak to our clients and those listening about what went right for us the first 6 months, what went right for the market, as well as what's not working, what the mistakes that we may have made, some of the changes we've done for our clients. We talked last week, of course, we talked about our strategy for fixed income. As David eloquently put, we are increasing fixed income slightly as a result of, at least for some of those older clients or retirees, a better, at least excluding the conversation I had about real, the better returns for fixed income, as well as the strong market performance of a lot of our stocks and the higher valuations. Just off the top, I think what I've been telling clients now is probably the biggest risk going forward is valuations. We've had strong moves in the markets. Stocks, a lot of our stocks are at higher valuations, maybe at all-time high valuations. One could easily point out Costco, for example. We started buying it for clients around 35 times earnings, and now it's 50 times earnings, right? So is Costco that much better a company than it was when we bought it a few years ago? Well, maybe it is. We'll only find out. But of course, if you are buying stocks today with higher valuations, it could impact your long-term return. That being said, no one knows the future. And even if we're getting decent returns on some of our stocks, there's no reason to sell or panic or do anything about it, but something to keep in mind. I really think that valuations are probably the biggest risk in terms of what could happen going forward. But of course, we're talking here July 16th. You saw the assassination of Donald Trump attempt on the weekend. Anything can happen that could change the trajectory of market performance. And so we just don't know any of the future risks. But this is one thing that we would point out, that our stocks as attractive as they were a year and a half ago? Of course not. But on the flip side, and I'll let Ernest jump in here, but earnings have been very good. We'll hopefully have a podcast next week. We'll talk about some of the earnings that are coming in. Interest rates are starting to come down. So there is a better picture for stock markets going forward. But all of that being said, anything could happen. Your take on what I just said?
So
you agree or disagree?
So I want to take a step back, just to put a comment out there, is that we're not allowed to discuss specific performance numbers on this podcast for compliance reasons, but they are available on our website for anybody who's interested to see.
BaskinWealth.com, and you can find, we have published historical returns and of different strategies that we have for clients, so check it out.
But we had a pretty good first half of the year. Our returns were good. They were spread out among a wide range of our names. And
it wasn't just one or two stocks that worked.
Right. And I think this is important because there's a narrative out there that there's only a few stocks that are driving the entire market.
Yeah, if you don't own Magnificent Seven, or if you own anything aside from NVIDIA, then you're not making any money.
Right. And if you run the numbers, I ran the numbers, and 2/3 of the S&P 500's gains for the first half of 2024 were from 5 stocks.
Okay. Wow.
Which were NVIDIA, Microsoft, Google, Amazon, and
Meta?
no, Apple.
Apple, okay.
Yes.
Meta's a smaller weight.
Meta probably contributed a
I
decent
think
amount.
Meta was up 100%, but I could be wrong. Yeah. Okay.
So those 5 stocks contributed. They were responsible for 2/3 of the index return.
Yeah.
Which
Yeah. Go ahead.
no, but I think the important thing to keep in mind is that the only reason why they were responsible for so much of the gain is because these are the largest companies in the world.
Yes.
The index is weighted by market cap. So large companies, of course, are going to influence the index more.
So when you read these headlines and, oh my God, the concentration and only a few stocks, but that's how the math works. I'm sorry that's how the index is created. And these are the largest companies and the most profitable companies and the best businesses in the world today, right now. So if NVIDIA doubles, of course it's going to have a huge influence on the index. If Apple goes up 35%, which I think it recovered from at the low point this year, of course it's going to have a massive influence on the index. But so many people ask, Ernest, I know we're getting off topic, but is that concentration doesn't make any mathematical sense?
Well, it doesn't matter.
Yeah.
I think if you are a stock picker, if you're not owning the index, there's no reason why you have to be concerned about the performance of these 5 stocks.
Yeah.
Because there were plenty other stocks you could have picked that could have gone up or down.
So they generated 2/3 of the S&P 500. But what about that you listed 5 stocks? There's 495 other stocks in the S&P 500.
So I ran the numbers. 114 names out of 500 are up more than the S&P 500 year to date, which was up about 15%.
It was up bang on the
As
nose.
of June.
Yeah, as of June, up 15%.
So 114 were up more than 15%.
That's pretty good.
Which was, about
22%.
About 20%-ish.
Yeah.
And 338 names are up, just greater than 0%.
Okay.
So yes, if you're comparing yourself to NVIDIA, you might be very disappointed with your results. But if your goal as an investor is to make money, then there were certainly plenty of other stocks you could have owned that have done very well.
Yeah.
So, and if you break it down by sector even more, I think you can tell, obviously, information technology has done really well. Communications, which is companies like Netflix and Google.
Not all communications companies, though. Charter and AT&T and Verizon aren't doing well, but yeah.
But those have done very well.
Yeah.
The weakest spots were things like real estate, which remains impacted by interest rates, and things like consumer discretionary. So companies like Nike and Starbucks have done very poorly.
Very bad this year. Okay.
So as far as our own portfolio, I think we were kind of lucky to be we had a good half, but it was partly, I would say, it was partly luck, not being in the wrong places and partly being in the right places. Well, we're not managing the portfolio for a 6-month period of time.
No, we're not a hedge fund. We're not short-term investors. And yes, when we do well, it's luck, and when we don't do well, it's the client's fault, right?
Yes.
Yeah, okay.
It was we didn't own some of the companies that did really poorly. A lot of the names that we owned outperformed their own sector, which. I wouldn't say it's all luck, because we generally own the market leader, which is generally gaining market share and doing well in rougher times.
Yeah.
So it's not super surprising that our names are outperforming, but we had a good half.
All right, so we applauded ourselves. Let's talk about what we got wrong, Ernest, in the first half of the year. Obviously, there's things that we could have bought that we didn't. I hate those discussions because we never did research on them. And so saying, well, why didn't you buy NVIDIA, or why didn't you do this, or why didn't you do that? It's like, if I would have done every A, B, and C right, I wouldn't be managing your money. I would be on my billionaire yacht with partying with Jeff Bezos.
Right. Should have just sold everything and put it onto NVIDIA.
Exactly.
At the beginning of the year.
Exactly. But what stresses me up, what keeps me up at night is, what we own that's not working, what we researched that we passed on, or that something we sold and, oy, why did we sell that? One of our biggest mistakes was in late 2023, we sold JP Morgan. And that, the stock has almost doubled since we sold it. At the time, I think, when did we sell it? Was it mid 23?
No, I think it was earlier than that.
Earlier than that. So I think we were concerned for a number of reasons about the U.S. economy because of the high interest rates. We were worried that there would be a recession. We were worried.
Higher capital requirements.
Yeah, higher like so much Yeah, there's a litany of reasons. And all those turned out to be bad worries, right? So, we had owned JP Morgan for quite a long time. We really owned it because we believed in the quality of management from Jamie Dimon, as well. The biggest, largest U.S. Bank, too big to fail. It had a lot of protection, a lot of moat. Going back at the time, I guess our reasons for selling made sense. But, when you look at the price of the stock today, obviously it's not hard to get upset about the decisions that you made. And obviously you can learn from those things. Your comment on that?
No, I think it's really hard.
Yeah.
Because another perhaps even more costly example was Meta.
Yeah.
We sold Meta in 22.
Yeah.
And then for about, I think 4 months, we felt really smart because the stock kept falling.
Yeah.
And the reason that we sold Meta in 22 was because, number one, they were facing issues from changes that Apple was making to the platform. So making their advertising business less effective. And they were splurging all this money on virtual reality, which I think nobody knew how that was going to play out.
Nope. They're still probably going to lose more money on virtual reality today than they were when we sold it.
Right. Yeah. And that hasn't changed.
No. Does anybody using its metaverse horizon stuff? Is that nobody? What are they doing?
So
anyway,
I think sometimes it goes, but then stocks up like, I don't know, 300% since that point. Mm-hmm. So it really goes to show you like how hard it is to make these calls.
I think if we've learned anything from selling things based on the what ifs is that maybe when there were calls for Amazon, when its stock was really underperforming badly, or when Google worries about is it going to be a complete loser in the world of AI, and that we maybe ignored that kind of upfront narrative at the time, learning our lessons about we can't worry about everything that's going right. Are the fundamentals of the business improving, going in the right direction? Do we have some confidence there? And so luckily we didn't sell those. We could have easily sold Google or Amazon at half the price they are today.
Right. I think it would. We've also made decisions that were correct.
Yeah. No, I just want to point out to the clients that clearly we do get a number of things wrong, but if you get only a few things right, it doesn't matter.
No, and I think it's an important point because it turns out that it's very hard to know whether your decision was correct or not, even in hindsight, right? And I think when you have a business I think Netflix is probably my favorite example of this because that was a business that we bought in 2019.
Yes.
Went to the moon in COVID, went back to Earth, down like 70% in 22.
Yeah.
And then they rebounded all the way.
Yeah.
And I think in the case of something like Netflix, in 22, when the stock was falling, you had like famous managers saying, I got Netflix totally wrong. Right?
Yeah.
Like everyone was dumping the stock.
Yeah. Bill Ackman, who had just bought it like a few months before, just cashed out his entire position after one lousy earnings report.
No, so I think in those situations, I think the key is really around, I think those are the times that really test how well you understand the company.
Yeah.
Like how much conviction do you have in the quality of the business and how it's positioned relative to competitors? How much conviction do you have in the management to be able to, make necessary changes to the business?
Yeah.
And so Netflix, because in the business world, things happen, right? Like
All the time.
like bad thing, like not everything's going to go as well as you expect it to. And so it's the job of the management to be able to react accordingly. So in the case of something like Netflix, they had, I think, 2 quarters of slowing growth. They realized they needed to make a change. And so they started cracking down on password sharing and launching their advertising tier. Whereas you have somebody else, like I'm not going to name any names, but you have some other companies that they kind of, like if you read their earnings calls, they would say, oh, it was just, macroeconomic weakness. Things aren't actually that bad. We think they're going to
transitory.
Things are going to turn around soon.
Yes.
I think those are kind of some of the names that are underperforming the most today because the management didn't recognize the situation and react appropriately.
Okay. So we talked about the what if situations and some of the moves that we did prior, but let's talk about a few of the things that we actually own and that did well, and things that we're watching and thinking that hopefully the reasons why they'll turn around. So some of the top performers in the portfolio, you've already mentioned Netflix. Anything to say there? Earnings are out this week. Maybe we'll talk about it on the next podcast.
Yeah.
Was that our best performer year to date?
In terms of this, yes,
Yeah.
it is.
Yeah.
I'm talking for the growth pool.
Yeah.
Particularly, obviously, every different client would have different.
Yes,
weightings.
we're just talking about the individual performance of the stocks that are held across the board year to date.
Yes.
Correct. Every client will have a different return.
Slightly different.
Yeah. So we're not going to talk about percentages or. Yeah.
But Netflix was our highest. Netflix stock was up the most out of anything in our portfolio.
Year to date.
I think, and what's interesting about Netflix is that if you contrast Netflix to all of its competitors, which include Disney, like Paramount, which is not a thing anymore.
Yeah.
I don't know, is Peacock still a thing?
No idea.
Okay. Basically, it's just Netflix and everybody else.
I think Peacock is dead once WWE moves to Netflix. But yeah.
Yeah. So what's really been abundantly clear in the last 2 years is that number one, Netflix has an insurmountable lead in streaming. They're the only ones that make money. They have the best management team. They have the best scale, which means that they have the most content. And so what ends up happening is that because they have the best scale, they have the best service.
Yeah.
It's the best streaming service that exists.
You call that a flywheel, right?
Yeah.
The more customers you have means the more money you can spend on content, means the more you can delight your customers, which means you can attract more customers, and so on and so forth, and offer a fair fee. Has Netflix pricing, does it make sense? Because it's also now the premium streamer. Does that make sense to you, given the tiers that they're charging?
So in Canada, for example, they just got rid of the basic tier.
Yeah.
Which, so basic being the one that is the cheapest plan. Now you have to subscribe either to the ad-supported tier or you have to move up to standard. So
basic had no ads.
Basic had no ads.
Okay.
I think just maybe one or two concurrent streams with lower quality. But now you either have to get ads or you have to pay for standard.
Yeah.
And so only Netflix can do that, by the way, because if you were like a Paramount Plus customer, you'd probably cancel.
Yeah.
If you churn them, if you cut out the customer and say, okay, you either got to pay for ads now, or you got to pay more. They probably just cancel. But Netflix can do that, and I think that's one of the reasons why it's reflecting in the stock price.
Yeah. So expectations are for a very good year for Netflix, and we'll see what happens. I find myself, Ernest, watching a number of different streamers because I like a number of different shows, but I would assume in the future, given that Paramount Plus is probably done, that people are going to be selling things back to Netflix again. So,
no, and I would say for Netflix, probably more so than the vast majority of our portfolio, I think it's underappreciated how much every dollar of additional revenue flows to the bottom line. Because if they add a new customer, they don't really have to spend more on content. They're just watching the same thing that they already made.
Yeah.
So the profit growth relative to the revenues even from a modest increase in revenues, the profits go up
Yeah, no, it's
way through the roof.
It's a great scale business. Okay, so the second best stock year to date is Google, Alphabet.
Yep. So Google's interesting because really starting from 2023, you had a narrative that Google search in particular was going to be disrupted by AI.
AI, yeah.
No one was ever going to search on Google again. Everybody was just going to use ChatGPT or use Bing, right? Was that what the narrative was?
Was Bing a thing?
Yeah.
Yeah. Until people tried actually using Bing and said, my God, it's just as terrible as I remembered it was, and never use it again, even with AI or what have you.
And then to the point about, management's pivoting, maybe they were a little bit slow on the uptake, but they've announced what they were doing with AI. And I think it's now abundantly clear that they're going to be able to pivot successfully. And I think that's what's going on with the stock.
Meanwhile, I think the cloud numbers, it's Google Cloud is delivering better results. And that was kind of a drag on the profits, right? It was a money loser for a number of years and it's turned and inflected positive. So that's a good sign that Google, some of the money that it's been investing in everything non-search is being additive to the bottom line.
Right. And I think this is an important point for Google, Microsoft, and Amazon in particular, is that you can argue, I think there's a view out there that these stocks are just being driven by AI, right? It's like, oh, everybody's going to use AI and they're just pushing the stocks up.
Yeah.
I don't think that's necessarily true, because if you think back to 2022, there were concerns about a lot of these, like just macroeconomic concerns about these businesses. Advertising was slowing down, cloud computing demand was slowing down. These businesses, I think people thought they were they had too many employees.
Yep.
And so
I remember that narrative, and actually a lot of them did get rid of headcount tremendously.
Right. And so arguably a large chunk of the performance over the last year or two, I think, just is from these headwinds ending. Like the ad market has picked up again, software demand has picked up again, enterprise demand for cloud computing has picked up. They've cut costs and profits are higher. So I think that's responsible for a large chunk of the valuation too.
And didn't Google move its CFO to CEO position? Or
no, so she's so she is a special advisor now. I don't remember the exact title, but yeah, she's no longer the CFO, but she's now, I think it's like chief investment officer, she's just she kind of retired, but not really.
And they hired the CFO from Eli Lilly.
Yes.
So many people are excited for that move. I think they think there's good capital allocation in Eli Lilly and potential for Google to continue to be aggressive buying back stock. Let's do a couple more. Costco, we've talked about ad nauseum.
Yep.
I don't think there's much more to say except the exciting thing that happened last week. The announcement of the fee hike in membership, although I see the stock at the beginning, the stock went up. It's now much lower than it was prior to the announcement. Was that just based on expectations or valuation, or who the heck knows?
Yeah, who knows?
Who knows? Stocks go up and down.
Yeah, I think the fee hike, what's interesting about the fee hike is that it's really not that big of a deal if you think about it. It's like $5 per member per year, which is like a few cents per month. But the fact that Costco spent this much care into thinking about whether they want to raise fees $5 a year, right? I think it shows you the quality of the management.
$10 for executive members, though.
Yeah, but they also raised the threshold.
Yeah.
That qualifies for the 2% reward.
Yeah.
And so I think that the reason that Costco didn't raise the fee before was mostly they didn't want to be viewed as raising prices when everybody else was raising prices, right? Even as goods inside the store were probably going up a little bit.
Yeah, I think also Costco probably waited to inflation to calm down,
right?
To think now it's a good time to do it. I think the management probably felt that this is just would punish our customers. The price of food and everything has gone up, and then here we are being greedy schmucks and raising the membership price. So good timing.
Yep.
Just goes to show you that Costco management is the highest quality. Constellation Software, not the most exciting year so far, or was it? Constellation.
Well, they've done more deals this year than last year.
Yes, I don't think the size of the deals is as big.
No.
Yeah, no. But
Yeah, I think Constellation, they continue to do what they do.
Yeah.
Like I think for a lot of these types of so-called compounders
Yeah.
that have an operating model that go out and do acquisitions, I don't really think there's a bad time to buy a lot of these names because they're going to continue to execute. And yeah, I think it would be a mistake for investors to say, oh, it's up, I don't know, 20% this year.
Yeah, no,
I'm going to wait for it to pull back before buying because odds are it probably won't.
Your best ideas can come from the 52-week high list or the 52-week low list. It just because the stock is done lousy or well tells you nothing about the future.
Right.
You have to know. You have to have confidence in the future, in the business, the management. As we say all the time on our podcast, we're long-term investors. What's really important for us is partnering with strong management that have great culture and know how to reinvest cash flows at high returns and know what to do with the capital. And so I think those companies that you mentioned, Netflix, Google, Costco, Constellation Software, I think that fits the bill. It's hard to find better businesses than those four. Okay, so those were things that worked really well. Some of the names on the bottom of the list, Ernest, I was catching a glimpse here. It's not like their performance of the fundamentals for the businesses were poor. It's sometimes sectors fall out of favor. Sometimes people worry about the future of a sector. Adobe was our third worst performer. Yet, year to date, Adobe has raised guidance. The guidance that it thinks it's going to do this year is better than what it said at the beginning of the year, and yet the stock is down. I think it's really just a function of the stock price did incredibly well in 2023. Maybe some AI hype in there that has yet to live or at least come through into the bottom line. And so markets are just adjusting the multiple on Adobe as a result. Would you agree with that?
Yes, there was one of the CFOs of the companies we own. I'm not going to name which one, but he said to me something that was, I think, quite insightful. Because his stock was up, I think, quite a bit, like 20, 30%. So I asked him, are things really that much better than they were last year? And he said, well, things are never as good as they seem when things are good, and they're never as bad as they seem when they're bad. And so I think that's probably true for the names at the top of the list.
Yeah.
I don't really know what's going to happen to the stock price in the next 3 to 6 months for Netflix, for example.
No. Yeah.
But I think over 5 years, they're going to continue to add subscribers and gain market share.
Yeah.
And that's true for the names on the bottom of this list too. So the three worst performers for us for the first half of the year were CoStar Group, Floor Decor, and Adobe. I think CoStar impacted by a variety of things. Number one, commercial real estate is still very weak. They provide data for commercial real estate industry. So that's been a drag on results. Number two is that they've been investing a lot of money into residential housing market, which I think there's some skepticism about whether this is going to work out for them.
Well, CoStar's been a weird one, and so is Floor Decor this year, as both stocks were up meaningfully at one point in time in 2024 and then have pulled back. You'll get to Floor Decor in a minute, but CoStar actually, when it reported its Q1 earnings, raised guidance.
Yes.
Right? So the stock price is down year to date. Once again, it could be just a function of it did really well in 2023. Maybe the move up for some reason in 2024 was not justified and it's pulling back. Impossible to know.
Yes.
Yeah.
So I think we still have high confidence in the management to execute on what they're doing and think that the stock is pretty attractive.
Yeah. The main narrative right now with CoStar is its investment and building out the homes.com platform. The homes.com platform is a website where buyers and sellers of real estate can transact and see with home listings across. Is it in Canada too, homes.com?
No.
No. So across the United States.
Yep.
And it's competing against, if people in Canada know realtor.com, Zillow, there's a number.
Yep.
So there's lots of competition, but very few have the balance sheets and the expertise that CoStar has. Very similar, and we've talked about this before on the podcast, very similar to what CoStar did when it launched or purchased apartments.com.
Yes.
Lost money on it for a while, and people were skeptical, and now it's turned out to be a home run. Apartments.com, similar to homes.com, people can check apartment vacancies across North America. I think that one is in Canada, apartments.com. I could be wrong again.
They just launched.
They just launched. See, I got that one right.
Yes.
Okay, so Floor Decor, the final underperformer year to date. Stock's been on a wild ride. Why don't you just, because I don't know if we've ever talked about it on the podcast, quickly talk about our thesis, our reasons for purchase, and what's going on today.
So Floor Decor is a store where you can buy flooring from, as the name suggests.
Yeah.
They focus mostly on hard surface flooring, so things like tile, laminate, those kinds of things.
Yeah,
Stone,
you're redoing your kitchen, you're redoing your living room, your dining room, your floors, what have you, bathrooms. They sell all that stuff. It's not like a Home Depot where it has a million SKUs of different products, mostly focused on the home renovation market.
And the reason that we own Floor Decor is because they've built up a fairly unique business model where because they're directly sourcing most of their products, and because of the assortment of products that they have in their store, they are able to offer meaningfully lower prices, like often 50% more than competitors.
Less, 50%.
Yeah,
less,
50% lower.
Yeah.
Less, not
Yeah.
more. 50% cheaper than independents.
Yeah.
So, like, let's say you're doing a project and you go to your local flooring store. Floor Decor is probably going to have a larger selection than them and at a much lower price.
Yeah, typically they're opening 50 to 70,000 square foot stores, and your local Home Depot or Lowe's may have 1,000 to 2,000 square feet dedicated to flooring and tiling. So it's an amazing option. There's about 150 stores in the United States, has yet to crack into Canada and Mexico. The runway of growth is quite large, but it's facing a tough problem right now with interest rates the way they are, with people having locked in their interest rates in the U.S. at now very low rates. And with housing prices gone up, there's no incentive. The turnover of housing has slowed dramatically. And with mortgage rates in the U.S. at 6 or 7%, there's not a lot of incentives to get people to buy houses, right? So that's what's hurting the volume of the business.
So what we underestimated about Floor Decor when we bought it was just how cyclical flooring demand was to interest rates. Because when interest rates went high, not only did housing transactions fall, which most people usually do the floor when the house is bought or sold.
Yeah.
But people were putting off flooring projects as well. So instead of redoing their whole living room, maybe they'll just do the bathroom and the kitchen.
Yeah. And I think what we may have gotten underestimated in the short term, I was going to say wrong, but wrong depends on your time horizon. But what we underestimated in the short term was how, because of interest rates were so low, people use their house as an ATM and lots of renovations. We all know people who did renovations during the pandemic, added pools, whatever, and that stuff has really come slow to a crawl, which makes sense.
Yep. But I think the reason that I still like the stock, especially at where the stock is today, is that they're still earning pretty good returns from opening new stores, and which they're continuing to do. And we are at probably near a cyclical low, because housing transactions appear to have bottomed and are likely going to pick up.
Yeah, there's always a risk that you sell at the bottom because the stock price is underperformed, like everybody knows that Floor Decor is going to have a tough 12 to 18 months.
Right.
Like there's not going to be a surprise if Floor Decor comes out with its earnings and says we're lowering guidance. Like who's going to be shocked by that? Nobody. We've already seen news from it's not a direct competitor, but Pool Corporation, where it's one of the main beneficiaries of the installation of new swimming pools, hot tubs across North America. Like no one's putting in a pool. They may make money selling chemicals, but not the big one-time upfront cost of building a pool. It's not happening. So that would be a similar thought process for Floor Decor. So, and of course, the stock is, yeah, it's not done terribly recently, but it's down from, I think it was $130 a share a few months ago, and now, of course, it's down to 90. I'm not sure we can learn very much from the stock price swings. What we want to more focus on, and Ernest said it importantly, is the long term of the business. The model makes a lot of sense. I don't think anybody's going to be opening other 70,000 square foot flooring businesses to compete with it in this environment.
No, and I think that's an important point, is that if you own a good business that is leading the industry, they have a cost advantage, very likely they're going to end up gaining market share in tough environments.
Yeah.
Because whatever pain that they're feeling is being felt much more by their competitors.
100%.
So like Lumber Liquidators is one of their competitors, and they just went bankrupt.
Yeah.
And so coming out of this, Floor & Decor is going to be in a much better shape than before, as we saw with Netflix, for example.
And there's lots of levers it can pull to at least protect itself. Doesn't have to open up as many stores. But long term, I think the thesis is, Ernest, that there'll be many more Floor & Decor stores, potential to sell into other countries like Canada and the US, potential to get more into the commercial design space, and eventually become a really a gigantic business. And you can't the housing slowdown in the US, that can't continue forever. Interest rates will move around. We're all cognizant of where interest rates are now. Things will move around. Things will adjust. The housing stock is going to age. The population is going to grow. Focus on the thesis of is the business in the future going to be bigger and better? And is the management, do we have confidence that the management is doing the right thing? And can it survive the downturn? Those are the important things for us.
That's well said.
Hey! Okay, so anything else you want to add on the winners and losers?
I will say there's been a lot of chatter about whether we are in a bubble.
Yeah. I kind of talked about that before, about when I said I think the biggest risk is market valuation. Yeah.
And talked about this on BNN a couple of weeks ago, but I really don't think so. Like, obviously you don't know what the stock market's going to do over like any period of time in the short term. But if you compare today to the markets in 1999, for example, or even in more recently 2021, it's just not the same. Like, yeah, certainly Nvidia and super microcomputer are up substantially.
Both profitable businesses,
yes,
though. Yeah.
But then the main difference is that the capital markets overall remain fairly muted. Like, you're not seeing like a flood of unprofitable IPOs. You're not seeing like venture capitalists out there like pushing companies to go public to take advantage of these valuations. You're not seeing companies just say like, oh, I'm an AI company, and then the stock price goes up 50%.
Yeah.
You're not seeing any of that. And
only with True Social are they.
Yes.
Yeah. Okay.
And then lastly, like, you're not seeing retail participation in equity markets still fairly muted.
Yeah. I mean, we did see a couple crazy moves in GameStop and Chewy.
Those are tiny.
Yeah, but that's nonsense.
And there's still record levels of cash invested on the sidelines.
Enormous. It not only held by retail investors, but also by private equity that are chomping at the bit to put it to work.
And then lastly is that, to your point in the beginning, is that interest rates are more likely to fall than go up in the near term. So you put that together, like, sure, like somebody might disagree about the valuation of NVIDIA, but I don't see the conditions for a broad market decline overall.
Well, as Bill Miller, one of our favorite investors, always says, are things getting better or worse? And that will tell you the direction of markets and stocks. And if you think things are getting better, then even with the higher valuations today, it's possible markets continue to do quite well going forward. We don't know, but we're certainly hoping that's the case. Thank you very much for joining us, and we'll see you back here real soon.